Jai Guruji, Shukrana Guruji. Welcome to this presentation on asset valuation methods, traditional approach and statistical approach. Here we'll evaluate the major differences between the two approaches to asset valuation. The differences between the traditional and statistical methods of asset valuation. The difference in approach, assumption and treatment of uncertainty. Some traditional asset valuation methods. Suitability of various methods of different scenarios, merits and demerits of the methods. Characteristics of Monte Carlo asset valuation method, a statistical method. Graphical representation of probability distribution of the asset value. Graphical depiction of Monte Carlo method of decision making using net present value of an asset. Graphical depiction of conflict of result between traditional method and statistical method in asset valuation based on NPV. A brief explanation of other statistical methods used in asset valuation. The specific situations where they are used. I am Aninda Datta, the presenter. Now the difference between traditional asset valuation methods and the statistical methods lies in their approach, assumption and the treatment of uncertainty. As per the traditional method, the input assumption is that it uses single point estimates, example a single revenue figure, a single price points for a major revenue items and single cost figure. And as per the statistical methods, it uses probability distributions for uncertain input variables like triangular distribution for raw materials, log normal distribution for sales volume, and normal distribution for fixed costs. Treatment of uncertainty in revenue or expenses. In the traditional method, generally ignored or handled through sensitivity analysis. In the statistical methods, uncertain items are explicitly modeled, like revenue would be normal distribution with specific mean and standard deviation. Say, for example, a mean of 20 million and standard deviation of 5 millions. The traditional method output is a single deterministic value. Example, net asset value is 100 million. Discounted cash flow is 140 millions. Whereas under statistical methods, output is a distribution, a range of values with mean, median, and standard deviation and confidence intervals. Risk adjustment is done via discount rate or risk premium. So models have limited flexibility in capturing real-world variability. Under the statistical methods, risk adjustment is an integral to models through distribution. So models could be complex, flexible, and depict the nonlinear relationship. Now, traditionally, various methods are used for asset valuation, each having its merits and demerits. Now, let's evaluate each methods and its suitability and the areas not suitable for the individual methods. Discounted cash flow methods estimates the present value of future cash flows using a discount rate ideal for businesses with predictable cash flows like infrastructure assets and rent-based real estate. Not suitable for companies having unpredictable cash flows like startups, assets with no cash flows but held for capital appreciation like land. Comparable company analysis. Values of business based on valuation multiples. Example, price earning multiple, EV by EBITDA of similar companies. The method is suitable for companies in mature industries, assets in standardized industries like manufacturing, etc. Not suitable for companies, for unique and non-standard industries, companies with no listed peers. Net asset value and book value method. Value equal to total assets minus total liabilities, based on balance sheet values or market values. Suitable for asset heavy industries like airlines, shipping, and during liquidation of companies. Not suitable for businesses not physical asset heavy but in skill based services relying on intangible assets like brands, etc. Precedent transactions uses valuations from recent merger and acquisition transactions involving similar companies or assets suitable for merger and acquisition valuation. Not suitable for illiquid markets or for absolute assets or completely unique assets meant for specific applications. Let's evaluate some more traditional methods of asset valuation. Replacement cost method. Values assets at cost to replace them or value at market value adjusted book value. Suitable for insurance claims of fixed assets like plant, machineries, etc. Areas not suitable for the method. Not suitable for intangible assets like intellectual property rights, brands, etc. Capitalization of earnings methods. Converts future earnings into fixed asset values using a capitalization rate. Suitable for single line of business with stable earnings or stable service businesses. Not suitable for businesses with volatile earnings, not having much past earnings history. Dividend discount models. Values a company based on the present value of expected future dividends. More suitable for mature dividend paying companies like utilities, FMCG. Not suitable for startups, high growth companies, cyclical businesses which do not pay dividends or future dividends having high chance of increase. Residual income method. Values a firm by adding economic profits to the current to the current book value. Suitable for firms when traditional earnings based methods are inadequate, but firms generate profits higher than the cost of capital. This method is used only when traditional valuations cannot correctly value an assets like firms having high intangible values preventing use of NAV, volatile cash flows preventing use of DCF, etc. Monte Carlo asset valuation method is useful in valuing assets where value is highly sensitive to uncertainty dependent on multiple variables as path dependency. Useful in valuing various kinds of options like American options, Asian options, and barrier options. Used in capital budgeting considering uncertainty in input variables and cash flows. If single point NPV is calculated using discounted cash flow method, then the actual NPV is sure to be different from the projected NPV. So it could be said that single point NPV is determined with 0% confidence level. So to increase the confidence level of the projection, a range of NPV values is needed. Higher the confidence level of the projection needed, broader should be the range of NPVs. The probability distribution of NPVs covers the 100% range. Even though Monte Carlo is a powerful tool in incorporating uncertainty in asset valuation, it has the following drawbacks. High computational cost due to high number of iterations needed to produce the stable result. Garbage in, garbage out. Quality of output depends a lot on assumptions and input distributions. It assumes predefined probability distributions for uncertain variables. While it models random variation, it may not capture black swan events. Concepts like probability distributions or confidence intervals may not be easily understood by business executives. Chances of overfitting in option valuation. Now, Monte Carlo uses a probabilistic approach to asset valuation as it gives a probability distribution of asset values. Monte Carlo is used extensively in discounted cash flows method of asset valuation. Monte Carlo simulation assigns a probability distribution to each uncertain variable. The kind of probability distribution to be assigned is user defined like normal, log normal, etc. The input variables that could be assigned probability distributions are sales revenue growth, raw material price, discount rate, etc. Run thousands of simulations from the assigned probability distributions of uncertain variables to generate probability distribution of possible company valuations. Each uncertain input variable adds variance to the distributions of DCF values. So generally more is the number of input variables, higher is the variance of the output values distribution, provided the input variables are independent. Now this is a graph which shows the output values distribution having different number of input variables. Like here the underlying input variable is 1. So the output value variance is quite narrow. The distribution is quite narrow. The variance is quite low. As we move rightwards, the number of underlying input variables increase. Under this blue value distribution, output value distribution, there are 5 input variables. So this has the very high variance and the distribution is quite wide. As the number of uncertain input variables increases, variance of company value distribution increases. However, if the input variables have negative correlation between the variance of distribution of NPV may not increase proportionately. If there is only one uncertain input variable, then the NPV will have the same distribution as the input variable, provided the relationship between the input variable and the NPV is linear. The output being the distribution of company values with mean value, standard deviation, and confidence intervals. Now, how to use Monte Carlo NPV valuation for decision making? Suppose the output is normal distribution of NPVs. Of course, it could be any other distribution. Now, this shows the normal distribution of the NPVs. This is just the shaded blue shaded region is the 95% confidence interval. That means the total area represents the total probability of 1, and this shaded region reflects the cumulative probability of 95%. So it starts from 30.4 million. The low bound is 30.44 million and ends at 69.6 million, and the mean, this is 50 millions. And this unshaded region represents 5% of the cumulative probability, 2.5% on this side and 2.5% on the right side. This is the output of Monte Carlo simulation, mean 50 million, standard deviation of 10 million. The shaded region represents 95% of the total area. 95% confidence interval, the shaded represents from 30.4 to 69.6. Company gets the range of expected NPVs with 95% confidence interval. Now this is another graph. Here's the normal distribution of NPV showing the maximum NPV value that could be earned with 95% confidence level. So here, this entire area, this shaded area on the right side represents the 95% of the cumulative area, that is the 95% probability. So this intersects the NPV axis at 33.6. So if the company wants to arrive at the NPV figure which could be earned with 95% confidence level, then that is this 33.6 million. If we move higher into the shaded region, the NPV amount will increase, but the confidence level reduces. Now, if we move rightwards, suppose we arrive at 40 million, then this cumulative area reduces from 95% lower. So if the company wants to see at what confidence level it can earn 40 million NPV, then the confidence level reduces. If we want the maximum NPV that could be earned with higher confidence level, then we move left into the unshaded region towards the NPV accounts. Now, if we want to increase our confidence level, then we have to move to this area, but the NPV level increases. Suppose we want to see how much NPV could be earned with 98% confidence level, then we have to move towards the left side, and the figure should be somewhere around here. It will be lower than 33.6 million. Now, the traditional method will only use the mean NPV in choosing a project, ignoring the standard deviation and the confidence intervals. Now, this is a project. This is the normal distribution of NPVs with a mean of 60 million. Now, if the company wants to see at what NPV could be achieved with 95% confidence interval, then it has to come to the point where this shaded region starts, because the entire shaded region represents a 95% probability. So this shaded region starts at a point of lower bound of 30.4. So the company can earn 30.4 millions of NPV with 95% confidence intervals. Now let's evaluate a project whose mean normal distribution NPV is higher, mean 60 million, and a higher standard deviation of 18 million compared to the previous project. So that is represented by this graph. If a company has to choose one of the two projects, then using traditional method, the company would choose this one, as it has higher mean expected value NPV. However, this project has higher variance also, so has higher probability of not achieving the mean NPV in real world. So a company could use the NPV figures of both the projects that have 95% probability, that is quite high chance of success of achieving. Project A is 95% confidence level and NPV figure is 33.6 million, whereas project B has 30.4 million. So project A is preferred using the statistical method, that is the risk adjusted method, and a risk adverse company should generally choose project A. So there could be a conflict of decision using the traditional method and statistical method, as traditional method does not consider the uncertainty around the single point. Now let's evaluate other commonly used statistical methods for asset valuation. An illustrative list as new methods are added continuously. Time series. Time series analysis is widely used in asset valuation to model and forecast variables that influence asset prices, such as cash flows, interest rates, market returns, and volatility. There are various kinds of time series. Arima model is used to forecast sales revenue, earnings, free cash flows, etc. Gauch model is used to predict volatility, which in turn is used to estimate beta, option price, etc. Regression-based valuation methods are used to establish statistical relationships between the market values and company fundamentals to estimate the value of an asset. Here are the coefficients of various fundamentals like earnings per shares are computed. Regression methods is used to value large set of comparable companies. Or market data driven alternatives to DCF is needed. Traditional valuation methods are hard as companies are loaded with intangibles like intellectual property, brands, etc. Bayesian methods are used in asset valuation, especially during uncertainty or absence of much data, and valuation methods given the high weightage to expert judgment. Bayesian allows to start with prior distribution of a parameter based on expert knowledge. As new data becomes available, the belief is updated using bias. Like a parameter, sales growth uncertainty in DCF valuation could be handled by Bayesian. This method is widely used in valuation of startups or high growth new horizon industries. So this concludes this presentation. More methods would be, all these methods and some more methods would be evaluated in details in the subsequent episodes. Thanks for watching.